Good morning, everyone. I'm Sharon Cook from Choice Commercial Finance, director and founder. And today we're just going to talk about raising finance in general. Finance is a funny old world, and I think people don't always realize the length and breadth of what we can actually achieve outside of the high street banks. And they don't always realize why they get declined or why something doesn't work for them and what they have to do to get ready for it. So I was going to go through some of those points this morning. Now, if I can, I'm going to talk a bit about business funding. And what we look at here is options for growth. So depending on what you want to do and how you want to grow, really. So growth works in lots of different ways. You can grow really quickly by acquisition. So buying bolt-on businesses, buying like-minded businesses, buying businesses you buy from to assure your supply chain, and you can grow really quite quickly like that. Sometimes you grow by marketing, increasing your sales force. If you use machinery or vehicles and you start building your fleets, you can grow like that as well. But the biggest part about growth, I think, is what happens is that you run out of cash. And that is one of the hardest things to do. And the bigger you grow and the bigger your customers, the harder it is to start negotiating that very important part of pay me in 30 days. And they go, no, I'm going to pay you in 90 days. And it's like, that doesn't really work for me, but I want you as a customer. So for me, and it's about finding exactly what you need at what time and when you need it. So acquisition finance can be done in many ways, can be done using some vendor finance, your own money, bank loans. It can be done using invoice finance and asset finance, and lots of ways of putting that together. A cash flow loan is a very simple thing. Go to the bank, go to a lender. I want X amount of money. You get the money, it's amortized, you repay it. Really simple, really clean, very, very quick outside of the banks. Asset finance, obviously, you're buying a piece of kit of description that can be owned by the lender until the day that you give it on and or pay it off. So one or the other. Purchase order finance, trade finance, and invoice finance are all very similar things. And they work in different ways and they work in conjunction with each other. We've all heard of invoice finance, and that comes now in many forms. It comes in singular, selective, full book, and there's some nuances out there as well. But sometimes with, if you have to buy a product, so you have to buy the components, make the product, sell the product, and then wait to get paid. That time frame can be really long, and it can really, really pull on your finances. And using trade finance to allow you to buy and import or buy from the UK, but buy the stock or buy the product, bring it in-house, sell it, and then exit with an invoice finance line can help really take out all of those lumps and bumps that you have. You might not want to do the exit of invoice finance, so you could just use purchase order finance instead, which is really similar to trade finance. At the moment, HSBC has a really good offering, but there are other lenders out there that does this type of thing. You've got a purchase order, they like it, you're buying a piece of something, you're buying something with it to sell on. And that's quite good to, again, help you get on that cycle to help break that 60, 90-day payment terms. If you're a retailer or online seller, there are specialist bits of stuff, merchant cash advance, where you can merchant cash advance and e-commerce stock finance or revenue-based lending are all really similar things where they look at your revenue that goes through your online sales or your credit card sales, and they lend you a percentage against that. So it could be 1 month or 2 months. And they lend you that. You can go and buy your stock, repay it, start the cycle again. Can be expensive, but it can be paid at source. So you don't have to save the money to pay it on a regular basis because it gets taken out as a percentage. And then we have revolving credit facilities, less so now after I've written this, because actually we've lost a couple have closed their doors recently. But revolving credit facilities like overdrafts or things you can dip in and dip out of and just use and pay for as and when you need it. And they come in many different forms, can be really helpful for businesses that have big peaks and troughs. And so just sort of, again, just using it when it's required. There's tons of specialist products out there. SaaS-based products where selling software as a service, I forget how you say that, that has its own specialist marketplace, which allows you to actually sell your product using investment, but debt investment without going to equity first. So using your pipeline of work effectively, and then re-engaging that back into it, so you don't have to go to equity too early. So you can actually use it for that. And then we have things that are secured against property. All these things probably sound fine, but there are nuances to each and every single one. I won't go into them all. Don't worry, you're good. But we have limiting factors with every single lender, and this is what we look at. So as a broker, I look at these things on behalf of the lender. So every single lender has different things. If they all had the same requirements, my life would be super easy and everybody could do this job. But the fact is, they all have different requirements. And these are some of the requirements that I think you should be looking for and assessing before you go to any lender to make sure that you're fitting those lenders' automatic declines, basically. If you have an automatic decline, it's probably because of one of these things. So home ownership. Whilst we all like to say to ourselves, we don't want to put our home up, we don't want to sign PGs, it's a fact of life. And actually, home ownership is one of the biggest things nowadays, where they say if you're not a homeowner, it's harder to find funding at a lower level. So funding below £1 million often requires home ownership, or your business has to be like extraordinarily strong. It's only because the PG value is what they're looking for. They're not looking to secure it, but it's an important factor, and it can mean an auto decline if none of the directors are homeowners. And we have to look at alternate sources. There are alternate sources out there, so please don't worry. But the fact is that this is the big thing. Looking at your company credit score and director credit scores. And I know people say, we're a limited company, they're lending to the company. Like, really, they're not. Like, I honestly, having dealt with hundreds of lenders in my life, from high street banks through to all the challenges and everybody in between, they look at the directors and they look at how you handle your own personal money. They look at how you've handled your past. They look at how you personally handle your mortgage, how you handle your credit card. They look at how you handle your £10 phone bill per month or whatever it might be. All these things create a picture. And all these things can actually create an instant decline if they're not looked at and not ensured they're in order. Your company turnover is important. And I still have it. People come to me and say, I'm looking for £1 million. And their turnover is £67,000. It's not going to happen. Your turnover has to be relevant to the amount of money that you're borrowing. And often we say 60% of turnover is about the limit for most lenders. And then obviously we have to look at profitability and affordability after that. But that's a rule of thumb. Number of years trading can make a huge difference. Anything sub 3 years is probably considered high risk, and therefore will come with high risk pricing, depending on the strength of the company, but also would look at something like the startup loan, or look at something along the lines of a different format of funding, where you're actually looking at your revenue-based funding rather than just your accounts. Your business history. Liquidations in the past count. So if you've had to liquidate a business at any point, A, we have to disclose, and B, if it's too soon, people won't lend to you, or you end up being a higher risk and therefore it costs more money. Having a healthy balance sheet is really important too. So making sure that you have a positive balance sheet is important. And if your balance sheet is negative, making sure there's a decent narrative around, perhaps it's based on investment or whatever, but why that balance sheet is negative, because a negative balance sheet means there's no worth in the company to someone looking at it. The other thing is your group setup or your structure. Sole traders are really hard to fund. Lots of people are moving away. Even if it's a perfectly legal setup, lots are moving away. LLPs and partnerships, again, becoming more challenging to fund. Limited companies are fine. And group companies sometimes can be excluded from funders because they can't take the group debenture or they can't do cross-company guarantees. And therefore, they step away from group lending. SIC codes, oh, this is silly. But sometimes if you've got the wrong SIC code on Companies House, it might exclude you from certain lenders. So making sure the SIC code that's on your Companies House records matches what you do is actually quite important. And lastly, and no means leastly, is the affordability. Can you afford this loan or this asset or the invoice finance, whatever it is, can you afford it and can the lender be repaid? I can't see you, so if you've got any questions, just have to shout for a second. We're just going to talk about headline rates because I know all these lenders are marketing to you all day long. You've been pre-approved, you've been this, we can lend you that. Come to us, click here, borrow instantly. It's not always a good idea because you don't actually know what you're being charged. So if somebody was going to offer you £50,000 at 10% or 8%, I'm pretty sure most of you would look at the 8% and go, that's got to be cheaper. They won't tell you if it's an APR and they won't tell you if it's a flat rate. They'll probably just put a percentage by it. But when you look at the cost of what you're getting yourself into, just on a 50 grand loan, the APR is cheaper because it's an annual percentage rate, whereas a flat rate is based on every single year that you pay. So a flat rate on 8% of 50 grand is 4 grand a year. And that's why it's a lot more expensive. So before you click the button and say, yes, let's take this, stop and ask the question, how am I being charged? And that's the most important thing. The lowest rate isn't always the best one. So I'm just going to exit the screen and get you guys back. So that's really, I've just run through that. I'm so sorry. Literally. Is there any questions from what I've said? Because I'm just aware we've got limited time this morning.
Has anyone got any questions for Sharon? If not, I've got
Stuart
Stuart's
has.
got his hand up here.
It's not a question. If no one else has got any questions, I just wanted to say to the group, hello, Sharon.
Hi, Stuart. Lovely to see you.
Yeah, I just wanted to say to the group, Jane and I had a conversation with Jane a little while back. We were introduced to Sharon through Innovate UK, and we sat down for I think a half an hour call with Sharon. It was really, really good. And I'm not saying that just to suck up to the person on the call. I
Thank you.
really, I really, I thoroughly, without any reservation, recommend chatting to Sharon. I mean, obviously, when she's not talking to a group, she's got much more time to zoom in on your situations. She asked the questions, immediately got where we were and which things were relevant, which things weren't. So I just wanted to say that I think Sharon did a brilliant job on that call.
Thank you.
It's much harder when you're presented to a group like this because you don't quite know who you're dealing with.
No,
So just sort of an intra-group recommendation there, if you think
thank you,
about
Stuart.
it.
Thank you. I'm still waiting on that pitch deck because I have
We
somebody
have
lined up to look at it for you.
we've got you at the top of our to-do list. We're
Thank
absolutely
you.
on it. Yeah.
Cheers, Stuart. I had a question. A lot of stuff that you're talking about as founders or startup founders, it's very hard to stay cash positive and look great throughout that time. Is there any way around that, or is that just nothing we can do about it?
Well, I think there's lots you can do about staying cash positive. And I think it's about understanding what's available to you in your particular situation. I started my business from scratch, and I know what it's like. You're literally all the time just pumping your own money in, thinking about borrowing, and it depends on your journey. Your journey is really important, and staging out your journey of where you are is important. For me, I think I now the startup loans have changed. I don't know if you saw that, but the startup loans now you can be trading up to 5 years, which kind of includes people that have just done a little bit on the side for a couple of years and then come incorporated to start a proper business. The startup loan could be quite powerful at 25 grand per director, up to 4 directors over 5 years. The interest rate has just risen to 7.5%, but that's still cracking. The interest is high, and thanks to the Bank of England nodding, it might go up again later on. It's good to be there. I think using the right product and understanding how the product, whatever it is, whether it's a cash flow loan, if it's equity, it's looking at the impact and the affordability from that. Bye, Andre. Um, and having really working that out and making sure, and that's how you handle your cash flow moving forward. I see it a lot where people take money but don't understand the consequence of what they've taken. It could be that the interest payments are too high. It could be that the time that they've taken the money over is too short. Amazon is a really great example of that. And this sounds awful. So I've had to bail people out who have taken a 1% Amazon loan. And you're sitting there going, 1%, that's amazing. But you try paying back 100 grand over 3 months.
Mm.
It doesn't matter if it's at 1%. You know, what the clients don't necessarily do is work out, yes, they go 100 grand, 1%, yeah, that's amazing. But actually, what's the cycle? How quickly is that going to pay back? If it pays back in 1 month, then great. Keep using that money. But so often that's not the case and things don't turn that quickly. So understanding sales cycle, understanding cash flow, understanding cost. And that last slide I showed you there on cost is really important. I I obviously care about interest rates. I beyond care about interest rates. It's my life. But the pounds and pence are the massive thing. Is the affordability, regardless. So it doesn't matter if it's 1% or 20%. If there's no affordability there, don't do it. Edward, hi.
Hi, Sharon. Yeah, our business, we're a medical device company. We've been around for a while. The company was founded in 2013. We have our CE mark, which we got in
Yeah.
2024. So that was 11 years. I've only been
Wow.
here for
Yeah.
6. So, um, we are now technically generating revenue, but it's not a lot. But just over a month ago, we signed a contract with the UK NHS. The headline value of that over 2 years is
Yeah.
3.5 million pounds.
Fantastic.
But there's no guarantee of that revenue. We have to basically create the demand.
Yeah.
Um, the good news for us is that the NHS supply chain will serve as our factor to the hospitals.
Yeah.
So we get an order. We don't have to worry about sort of any of that, those sorts of. But my question is, and I do have one, do you know of anybody out there who would lend against such a contract?
No.
I didn't
And
think so, but I just wanted to
no,
check.
no. Once the revenue starts
Hmm.
and it's proven. So I'm just going to give you an example of a client who went into liquidation because of a contract like this.
Hmm.
I'm not saying you will. And they were slightly different. So they were in transport and they had won a £3 million transport from Samsung actually to do,
Hmm.
but actually it wasn't a fixed £3 million contract. It was
Sure.
a we may give you up to, and they didn't. I
Yeah.
think they ended up doing something like 57 grand. But they'd
Hmm.
gone out and they bought the new trucks and they did this and they did
Hmm.
that. And so they completely veered in the right, as any normal business would consider doing. And then unfortunately that didn't happen. If
Hmm.
you need to accelerate any payments, then I would certainly consider singular invoice financing, um,
Hmm.
or consider having an invoice finance line with your bank to be able to
Yeah.
use and pay for the privilege. You could
Well,
I
like I
mean,
say, the supply chain will do. So when we
yeah,
get an order from a hospital, we fulfill the order, supply chain pay us, and then supply chain take the money off of the hospitals on a
of
quarterly
the
basis.
NHS.
So, and
Fine.
they charge us nothing for it. So that part is
That's
absolutely
cracking.
fantastic.
Okay. Yeah, you've got
The
that.
the
It's the
the other
upfront.
the other thing is that, and I can understand those sorts of contracts, and the NHS has a lot of contracts. Where we are is what we do is this is a urinary catheter, okay?
That's made
But
all the men
because
wince.
yes, but because ours has a magnetically controlled valve, we don't fit into the same category as every other catheter. And so if we were just another catheter company, yeah, we'd have to wait and be a call off amongst, 18 different providers. Our contract, there is but one company in that contract, and that's us.
Okay.
So it's, but getting people to understand that. But like I say, I don't think there's a group out there who will do that. And I don't
So
mean to monopolize the conversation here, guys.
no, no, and but it's a very interesting point, Edward. And when you start making those, I don't know your financial situation as you sit, so that's
Yeah, yeah.
obviously unknown at this point in time. But it could be that a CDFI might help you. So a community development funder. So
Mm-hmm.
somebody within your area or a bit more national, somebody backed by the
Mm-hmm.
GGS maybe. Um,
Yeah.
I've even seen HSBC back somebody whose turnover was, in my opinion, not enough for the loan, but she was
Mm-hmm.
making some sales and had contracts. So
Yeah.
it's something to do with like toothpaste, like tooth cleaning stuff for people who can't
Yeah.
necessarily clean their own teeth. So she had something similar. So I think using the GGS with somebody who will do it on cash flow forecasting,
Mm-hmm.
and maybe somebody that will do it in increments as well.
Yeah.
So you don't go for the 200 grand, you go for 50 with the
Mm-hmm.
knowledge that because you can afford it over
Yeah.
5 years, with the knowledge that they will look at it again in 3 or 6 months' time if you've reached your
Mm-hmm.
targets or exceeded your targets and have that renewed.
Right.
That would be something that's how I would look at it and see if I could get money into the business that
Mm-hmm.
way. It depends on how much you need.
Yeah.
Equity
Okay.
sounds an obvious answer
Yeah, yeah.
here.
We're in the process of raising equity now.
And I
Um,
know someone, I work with someone who does equity. If you want an introduction,
yeah,
then that's fine. More than happy if we can share details,
sure.
Gary, that would be amazing. But yeah, it's a hard one. So you're in that horrible situation, isn't it? That chicken and egg. So
Yeah.
yeah,
Mm-hmm.
done all that work, but it will take off. Or you sell your idea to somebody who's already
Yeah.
in the
No,
industry.
that is the exit plan that we are pursuing in parallel. But it'll it'll be worth a lot more once we have the installed base of users, as it were. So,
Yeah, I think the moment you kind of start making your first sale or couple of sales, that they'll see the
hmm
pipeline and you would be able to
yeah.
raise debt on that. I think the debt you should be thinking about raising um, outside of the banks. I mean, HSBC might come up trumps. I would say they'd come in at 9% HSBC
hmm
or another bank. If they won't help you, then you'll be looking at a CDFI starting at 12 over base.
hmm
But you can repay early, overpay, save on interest,
Yeah.
and get out of
hmm
it without any challenges. So whilst it's a bit heavy at the front end, it does get you to the next stage, and then you can
hmm
refinance out. So it's about
We
thinking of your plan.
we've looked we've looked in the past at Innovate UK loans. I don't know. Are they still doing those, or are they?
They've just made loads of people redundant. So they still have their grant scheme out there, but they
hmm
have just made a load of people. And if you want a contact at Innovate UK, I'm more than happy to pass you
No,
to my ones
we've
there.
we've been very fortunate. We've had three Innovate UK grants and one
Good,
NIHR grant as well. So we're good in with them.
good.
But
Yeah, they're not really doing much at the moment. Like I say,
mhm,
they've just made a load of redundancies. So
interesting.
yes.
Okay.
But do you manufacture that in the UK?
Yep.
That's
We have
good.
contract manufacturers here in the UK. It's all done here in the UK. So yeah.
That's good. That's good. When you get big enough, there is a grant, there's a decent loan out there for manufacturing loan. It starts at 500 grand, I think, and it is purely for manufacturing. So if you wanted to set up your own
Yeah.
manufacturing plant,
hmm
they would literally loan you the money to do that, and it's at a good rate. It's British business.
That does sound interesting. I have to jump to a call at 9, but Sharon, I
Right.
will reach out to you on LinkedIn. Would love
Please
to
do.
follow up. Thank you
Yeah,
so
of course,
much.
I'd be
Gary,
delighted.
thanks
Lovely to
very
meet
much.
you. Thanks for your time. Take care.
Cheers, everyone. Has anyone got any more questions, or we can let Sharon go because she's off to a do, as we used to call
I've got a dress on and everything. It's a posh one today. Um,
and it's going to be a hot one as well. So
it's going to be a hot one. Yes, I've
it's going to be
dressed
a hot one.
appropriately for it. I'll take my
Uh,
fan with me as well. A woman at my age, I need a fan.
And if no one's got any more questions, then I'd just like to say thank you very much, Sharon.
You're
And what we
most
do is
welcome.
I'll get Lee to share your contact details on our WhatsApp group and via email. So if anyone wants to get in touch with you, sounds
Thank
like
you.
Edward will do as well. So
Yeah, that'd be lovely.
yeah,
Nice to meet you. So thank you very much for the opportunity to speak to you all today. Really appreciate it.
great. Everyone have
Thanks,
a great
Sharon.
weekend and enjoy the sun. Yeah.
Thanks.
You
See you
too.
later.